This week has seen market jitters emerging from the bond market, where we've seen long-term yields in the US and Japan in particular spiking higher to record highs or historical highs. And that points towards the possibility of financial stress coming into play. Of course, we saw the downgrade from Moody's at the back end of last week, and there's a reason for it. The stability of the financial system comes into question when you see highly indebted nations seeing borrowing costs spiral. And there are implications across the board. So I want to just take this moment to look at the potential implications when it comes to the FX space, the stock markets, the commodity space, and some of the different sectors, trying to see who wins and who loses if we continue to see upside for bond yields in the US and Japan. So we've got a lot to get through. First and foremost, this is a chart to highlight exactly the direction of travel that we've seen. Long-term yields in Japan in particular spiking to record highs, the 30-year, the 40-year surging of late. We're also seeing the US 30-year spiking. Generally, when we're talking about yields, we might talk about the 2-year when we're talking about near-term expectations for interest rates under the likes of the Federal Reserve. We might look at the 10-year that's somewhere in between. It might have an implication in terms of borrowing costs for businesses, borrowing costs for people looking to take out mortgages and the like, but also the 30-year as those longer term debt packages that at the moment are really coming into focus, because that's where we're seeing some really significant volatility coming into play. And most notably, you're going to see a lot of the demand coming from some of the likes of the central banks and the like. And certainly Japan is an interesting one, because Japan is the biggest holder outside of the US in terms of central banks of US treasuries. And if we see yields continue to rise, there's question marks on whether they're going to pull that support out of the US towards domestic yields or domestic bonds. Now, I made a video earlier in the week, but this has a little bit of overlap and some similar topics, but ultimately we have a lot more to go into here. So first and foremost, we've got a huge amount of debt that's rolling over this year in the US. So they need to see demand. When it comes to demand, the question mark is, where is it coming from? Some of it comes from institutions, the private market. Some of it comes from central banks and the like abroad and around the world. And so they need to ramp up support. They need to find support. Now, at the moment, Donald Trump isn't necessarily in the good books of many other countries around the world. And there's a possibility that, like China in particular, utilize this as a tactic to be able to get what they want in trade negotiations. So certainly as yields continue to rise, it doesn't necessarily put the US in a great bargaining position when it comes to China in particular, but also Japan could use this to an extent. Of course, we've just seen the House actually approve the bill from Donald Trump. It has to go over to the Senate. But the idea of this growing mountain of debt in the US and the potential strain this could have on the US economy and fiscal position, that comes into focus with the fact that they're going to be borrowing more. They want to spend more. They want to tax less. And all of that has significant implications with the financial year 2027 deficit expected to be 1/3 larger with the passing of this bill. So that points towards markets having sort of two things to weigh up. The benefit of it, so the businesses that they might be buying having to pay less tax, for example, and people potentially having to pay less tax and therefore spending more. But then the downside in terms of the instability that emerges within the market, where they're continuing to borrow, they're having to borrow more and more, they're rolling over debt into new debt, and all of that is taking place at a higher borrowing rate. So they're essentially just digging themselves into a deeper hole. In terms of the annual deficit, that is expected to grow. And so when we're talking about the increase in borrowing, then that means that year on year, it just gets bigger and bigger. The debt pile expected to drop to 9% of GDP per year. They've taken over, I think it was 6.7% when Biden passed it over to Donald Trump. As we're talking about, Japan really comes into focus here. Japan has a huge debt market of its own, but also is a big buyer of US debt. You can see here in terms of the breakdown of US debt, who buys it? Well, the rest of the world, 33%. And the biggest of that is Japan. Second to that is actually the UK. It took over from China, I think, over the last couple of weeks. China's been sort of drawn away from it. The UK actually continuing to move into it. But as you can see, we've sort of got the US government, the financial sector, household. So we do have a number of different sort of domestic demand sources as well as the sort of regional ones. So rest of the world, roughly a third. And then when you look at that third, you can see here that Japan at the bottom in the green remains a big holder of US debt. There's a huge amount that is the rest of the world. But then China is gradually moving away from that. And in actual fact, more so moving towards gold, which is something that we'll touch on a little bit later. So one important thing to note here is that when you're looking at the countries, we're talking about the likes of Japan, which is the biggest holder outside of the US in terms of countries of US debt, and the US. Well, both of them are heavily indebted countries, and that's why they have huge bond markets. The likes of Japan, most notably here, 250% of GDP for their debt level, debt to GDP level, and then the US 123%. This is according to the IMF's latest numbers, or it's 2023. But that's not turning around anytime soon. So two heavily indebted nations. One nation in particular sort of invests in the bonds of the other country, most notably in the past because of the fact that with the Bank of Japan just keeping yields very low, so they didn't necessarily get a great return. So there was, of course, demand for domestic goods, but then also the demand for that foreign product, where the US is, of course, has the US exceptionalism story, where it feels like it's a very safe place to be, also much higher yields. But when you see a closing and narrowing of those yields, as we've been seeing recently with the Japanese having dropped their yield curve control, so yields rise in Japan, that gap between the two narrows, and so demand for the US rather than domestic products does start to dry up, meaning there's another source of demand that is fading in terms of US treasuries, and that means that they need to give ever higher prices. So yields continue to rise, borrowing costs continue to rise, debt continues to spiral over in the US. This is a chart to highlight the yields in one country compared to another. And what's notable here is the catch-up that's playing out in Japan, right? So like I said, we had yield curve control in Japan, where they essentially had a mechanism by which they wouldn't let yields run away. So essentially they kept rates at the BOJ at essentially nothing or negative. And they had yield curve control, which meant that yields didn't necessarily rise. So the cost of borrowing was rock bottom. And that's important because, like I said, they've got 250% debt to GDP ratio. That means they need to keep the cost of borrowing very low to keep things ticking along. Well, once that yield curve control runs away it comes to an end, well, what position are we in? Well, we've got a country that has 250% debt to GDP ratio. So if there's a highly indebted person, for example, and I come and say, look, I've got a huge amount of debt, can I take on more debt? What type of rate are you going to give me? It's probably not going to be the cheapest rate on the market. As you can see here, it has been, right? So that is going to change, and it is changing. We're seeing a narrowing of that gap taking place, which points towards potential shifts in terms of the behavior of institutions, central banks, individuals in Japan, and where that money flows to. No longer will it be the case that a huge amount of money is constantly flowing over to the US. Of course, there still is that differential, but if this catch-up play continues, which you would think would happen considering they're so heavily indebted, their yield should be higher, then that has significant knock-on implications going forward. And that's highlighted here, right? So that spread between the two, as it narrows, so if you take away the US 10-year yield, or you take out the Japanese 10-year yield from the US yield, as we see that narrowing, so we see dollar yen moving towards the downside. And so the strength in terms of the Japanese yen, so funds moving away from the US dollar to the Japanese yen. Could this be a source of strength for the yen? It's not necessarily an ideal situation, quite frankly, because of the potential implications for the carry trade. But certainly this is one to watch out for, because if we see a continued catch-up playing out when it comes to the likes of Japanese yields compared to some of the other yields around the world and the likes of the US yields, so that puts us into a position where we could see that narrowing of the spread, and therefore the possibility that we see a top in dollar yen going forward. Now, I wanted to look at some of the potential areas where we could see sector-wise it would outperform or underperform depending on where yields go, right? So, of course, there could be some measures that are taken by the central banks in particular to try and drive down yields, because that's something they need to do, right? But the economic conditions need to be right for them to do so by and large. And so as things stand, the direction of travel is very clear. Yields are moving towards the upside. We're seeing the US taking on additional debt. We've got the Japanese, where they already have a huge amount of debt. So their yields are likely to rise. The US yields continuing to rise. The Federal Reserve at the moment, considering the US-China deal, looking like they're taking a relatively patient approach. People thinking they might just have one more cut this year, and that doesn't necessarily do much in terms of driving down bond yields. So the trajectory for yields has been relatively well established as being a relatively bullish one, and that points towards potential moves coming into play for some of these sectors. So first and foremost, this is a chart of the 30-year yield in the US, WTI. So 30-year yield is purple, WTI is in black, and then the energy sector within the S&P 500. And what we can see here is all three of them on the left-hand side and throughout the middle have been moving in tandem. What does that mean? Well, essentially, the yields have been moving alongside energy prices because it's been reflecting the outlook for inflation, and therefore inflation, by and large, dictates what people think from central banks, right? So if they think that the Federal Reserve are going to cut more or less, and therefore we have significant knock-on implications from energy prices. But then more recently, we've seen with Donald Trump coming into power, we've seen energy prices really coming off. We haven't necessarily seen those energy stocks coming off in a meaningful manner, but now we've started to see the 30-year soaring. So we're seeing a divergence between the two. So no longer are we just seeing sort of inflation expectations driving yields. Instead, we're seeing yields rise due to a lack of demand for it and fears growing around the ability to essentially get someone to buy all of these bonds that they're having to issue as many of them mature. So we're seeing that divergence. And at the moment, it's looking like the energy stocks are essentially stuck within the middle of the two. But so it's probably more likely that that divergence plays out in the direction of a divergence also with those energy stocks, that they follow the price of energy lower rather than follow the price of yield. So this could point towards a potential for I would say catch up, but the opposite direction, potential weakness in terms of those energy names. So let's just look at the next one. So real estate. As you can see here, there's a very close correlation between real estate prices or real estate stock prices in the S&P 500 and the 30-year yield or bond yields as a whole. And the reason for that is that essentially we're going to see, when you see lower yields, you see the likeliness of stronger demand within the real estate sector because of the fact that we see cheaper borrowing taking place. Now, notably, we can see here that if we're looking at, say, the bond yields, we've inverted it here. And so in actual fact, we've got higher bond yields, right? Meaning weakness in terms of this sector, because higher yields means higher borrowing costs. So mortgage prices go up, weakness in terms of real estate names. And that's exactly what's playing out here. So if we continue to see strength in terms of bond yields, then that will continue to drive down valuations within the real estate market, because there's an expectation that essentially demand is going to dry up because it becomes unaffordable if you continue to see the cost of borrowing rise. So this is definitely a very close linkage between the two. And so if you're looking to trade in that sector, stocks within that sector, and you're looking for a potential turnaround or a continuation, you just got to look at where yields are going, and that sector is likely to follow. Bear in mind, that is a relative chart, right? So that is the real estate sector relative to the S&P 500 as a whole, which means when we see yields rising, we see relative underperformance for real estate stocks. And then financials, it's a really interesting one because essentially we're seeing bond yields moving towards the upside. People are fearful, but by and large, what we have been seeing previously is it's a reflection of inflation expectations, as I alluded to earlier, a lot of the bond movements that we've seen. And so we've seen a relatively positive correlation between financials, where we see higher yields mean higher margins, and bond yields, right? So if we saw a sharp decline in terms of bond yields, then they won't be able to make as much on their loans. Their margins are going to shrink. But what we've actually seen over the near term, I want to say near term, I mean just at the right of this chart, you can see yields surging and financials starting to roll over. It'll be interesting to see if that continues, because once you reach a certain point of bond yields going up, there's a feeling that this is happening due to economic distress, a lack of demand, and the possibility that the government's going to be in a financial problem, in a difficult position. If they need to roll over this debt, but they don't have the demand, they have to keep providing ever higher returns to be able to get the demand there. And that puts the economy into a difficult position. And that's when the financial stocks think, oh, okay, we don't want a recession. We don't want a market collapse, because that would have implications in terms of our earnings going forward. So they want high yields, but only to a certain point. And generally, they want yields to rise gradually rather than sharply. And you can see in the past, actually, that there's times where we've seen sharp rises in terms of yields, say around about sort of November time. And that's where we see that divergence take place. We see the financials actually underperform and start to move towards the downside. So there's a possibility that, we could see similar kind of things taking shape. And that also is the case when it comes to the S&P 500, right? So generally, rising yields means that people are confident in the economy because they don't necessarily want to take any treasuries, right? So if I buy treasuries, it's because generally I'm fearful, and therefore they don't necessarily have to give me a great price because everyone's looking to jump into haven assets at that time. So generally, rising yields means it's good for the S&P 500. And therefore, you should have that positive correlation. That's not always the case. And what we often see also is that when we see yields moving sort of sharply higher in a concerning manner rather than everything's great manner, that's when you see equity markets rolling over. So if you look at the sort of this big divergence on the far left of this chart and then the sort of middle left of this chart, there are these periods where we see that big divergence and the negative correlation coming into play. And that's because when we see a blowout, a surge higher in terms of yields, sometimes that can be concerning for markets, and then markets weaken as a result. That's possibly what could happen here, right? Where we see that negative correlation coming into play, where yields surge to a degree and to levels that become concerning, and therefore markets think, oh, this is a big problem. They've got a huge amount of debt that needs rolling over and servicing, and it's going to happen at such a high level that it questions the stability of the US at that time. And so I think there's a good chance that if we see yields continue to rise, then it sort of dampens sentiment within equity markets, and equities could weaken as we see yields rise, breaking the recent sort of positive correlation and the historical correlation that lasts most of the time. But then there are periods where we see that divergence take hold. In terms of the US dollar, generally we have a positive correlation. This is a recent event that we've seen, or sort of breakthrough, I guess, where that positive correlation is broken, right? And so they sort of move away from US exceptionalism suddenly starts to mean, instead of the US dollar sort of haven moving hand in hand with treasuries, now we're starting to see that potential breakdown and the divergence between the 10-year and the US dollar, where unfortunately you see rise in terms of bond yields, where people are demanding more if they're going to take on US debt. So again, that shows a lack of confidence in the US, despite the fact that equity markets are only like 3% away from record highs in the S&P 500, and a lack of confidence in the US dollar coming into play. And then so we're seeing that weakening. So all in all, this tells you a tale about a feeling that the US isn't really the place to be right now. Of course, the long-term trajectory always has been outperformance for US markets, but there's certainly a bit of concern around the US at the moment, and it's showing in terms of higher yields and a weaker US dollar. Now, one issue or one way to sort of resolve this, and this could come into play, is that the likes of the Federal Reserve could come in, right? So when there's a huge amount in terms of huge rise in terms of debt, a lot of the time it's the Federal Reserve that steps in. In one way, it'll be a case of expanding their balance sheet through something like QE. And at the same time, that sort of devalues the debt that they've already got. So it would mean the potential for weakness in terms of the US dollar as well. So they're essentially trying to devalue away the debt they've currently got, also trying to expand the balance sheet and help with the creation of new debt. Is that going to happen? It's difficult because right now it's a question mark of whether they want to do that and deal with the deficit issue and the debt issue and the rising yields issue, or deal with inflation. So it's a question mark of whether inflation is resolved or not. And it's the same kind of thing for the BOJ. Let's just look at that here. So in terms of inflation, energy prices have been moving lower recently. That has helped dampen inflation in the headline CPI for the US now largely under control. Japanese levels elevated 3.6% on the headline CPI. So there's question marks on whether they would be willing to act. If we're looking in terms of the sort of QE, in the past, that has been positive for equity markets. And it also has other implications for other markets, notably the likes of gold. So this is something we're talking about, the drawdown in terms of Chinese support for US treasuries. Instead, many countries moving towards the likes of gold and away from US treasuries. So US treasuries losing that demand as people instead are happy to go into gold. And so what this means is that gold is well supported through this process as well. And so we can go into that here. So here's the relationship between expectations around interest rates for the back end of this year. So where are rates going to be by the end of the year, overlaid with the US 10-year. And that highlights the fact that expectations of what the Federal Reserve is going to do will have a tangible impact on yields going forward. So the Federal Reserve can drive down borrowing costs, and they would have to essentially note that they're going to cut rates or going to enact QE and things like that, right? So a looser monetary policy from the Federal Reserve provides the basis for potential weakness in terms of yields. Notably, over the past year, we have seen rate cuts and yields have continued to rise, and that is very concerning. So whether they will sort of go all out to try and make moves to drive down yields, that remains to be seen. But certainly it's something worth watching. If we start to move towards a position where the Federal Reserve are willing to step in and provide a more dovish stance, then that would price additional rate cuts and potentially drive some weakness in terms of yields over the near term. So then if I take out the 10-year yield and I try and overlay as many things onto it as possible just to show you these relationships, right? What we've got here is interest rate probabilities. In the blue line, gold, which I've inverted, in the black line, the S&P 500 in the light green line, and the US dollar index in the, I don't know what you call that. I think it's a darker green line, essentially. And you can see there are close correlations between all of these, and by proxy, because of what I showed you on the previous chart, the 10-year yield and US yields as a whole as well. So generally, we have seen that yields move hand in hand with the S&P 500. But like we said, this is starting to potentially diverge from each other. So if we see continued upside in terms of yields, there's a possibility of weakness in terms of the S&P 500. However, you've got this sort of inverted relationship, which points towards a possibility of upside to come for gold in particular. The likes of the dollar index, notably playing out alongside this same pathway as well. So we've got that weakness in terms of the US dollar, despite the strength that we're seeing in terms of yields. So we're seeing that divergence playing out between yields and the US dollar as people lose confidence in the US. So I think there's a good chance that we could actually see divergence in terms of weak US dollar, weak US equities, and high yields. That's if we continue to see yields soar. And if we see that, then people start to become fearful. And what does that benefit? It benefits the likes of gold. People want to get into havens, but they don't want a haven based around the country that they're fearful around. And therefore, a asset that isn't tied to a country in particular comes into play. And gold is exactly that. And that's why I think gold remains very attractive. But look, there's a number of different assets that are going to come into play here. The question mark is really, are we going to see that some of these central banks stepping in and trying to resolve these issues that are currently playing out? Whether they're going to be able to remains to be seen, because ultimately we have seen rate cuts taking place and they haven't driven down yields, in particular in the US. And with a flood of US treasuries coming onto the market, how do they create that demand? Well, it could be created domestically from the Federal Reserve through QE or some other liquidity creating measure that isn't called QE, because that's probably going to spook markets. Alternatively, it could come through deals. China have been moving away from US treasuries. So could a deal with China, a trade deal, involve them potentially investing in US Treasuries in return for a better tariff rate. That's a possibility. But there's a number of moving parts. But at the base of this is to be able to watch out for what's happening in terms of yields. If they continue to rise, there's implications for many of these different markets across the board, many different sectors, as I've highlighted in this video. So I hope this has been useful. There's a lot of it. You can watch it back if you want. It's something that could become a major issue. It's worthwhile bearing in mind that yields have been rising for some time now, and equity markets have been very much willing to just push higher at the same time and just ignore it. The fact that the US is heavily in debt is no news to anyone. And many will just say, well, they can just inflate it away. They can create their own assets. That all is true. But then when we get to a certain point where we're seeing those debt costs spiraling and really surging in a very sort of vigorous manner, that's where it really grabs the attention of markets. Of course, we saw the Moody's downgrade taking place last Friday. We've seen the surge in terms of these yields. We've seen some of these bond auctions, which are going to become increasingly important as well. People will be checking out what the demand's like at these bond auctions. If the demand's not there and the yields just surge each time around, then that becomes a problem. So yes, plenty to get into, but this, I think, is one of the key topics you should be looking out for at the moment, one of the key indicators around the bond market and what the implications could be in terms of sectors, but also in terms of your FX, your commodities, your indices. Everything's impacted by it. So a big mover at the moment and a potential story that could grow in the weeks and months ahead.